Hey, what's going on, guys? Sorry it's been forever. I've been like doing back-to-back trips to DC for work the last couple weeks. So super busy and just didn't have the energy and time to get to these videos. So sorry about that. But the good news is you guys have been awesome. That last video, on the Q4 earnings was the best video by far. I picked up a ton of subscribers, so I guess that's my pitch now. If you do enjoy these videos, if you get anything out of it, please, 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 this is a tiny channel. If you could hit the like button and subscribe, that's a huge help. See if you like the content. If you don't like it, you can unsubscribe. I don't care, but it's a huge help when you do both those things. So thanks for watching. Just want to do a quick update on Fubo, on this interview that Gandler did. It's fairly short. Putting together a couple different topics I want to cover, so I want to release some stuff. I have some more travel in a couple weeks, so I want to put together a few videos and hopefully do like a couple per week over the next 2 weeks maybe. So if you have any topics or comments or things you want me to do videos on, just please comment, and I appreciate that. So we'll kind of dig into it here.
He's co-founder and CEO of Fubo TV. David, thank you so much for joining us this afternoon. So let's dive right into your latest results. You got it. You all did better than expected, posting an adjusted loss 17 cents a share. Street was expecting more than that, or worse than that, I should say. Revenue beat expectations, 410 million, more than 410 million. But the stock is getting a little beaten up here. What's going on? What can you tell us about your latest results?
Yeah, well, we've been public now for 12 quarters, and we've exceeded guidance 11 of the 12 quarters. And as you just stated, we had a super clean quarter. We're executing on all cylinders. We've been able to drive revenue, free cash flow improved by about $100 million. So any way you try and size it up, it was a fantastic quarter and a fantastic year. I think the issues around the stock, again, I don't usually comment.
This is pretty big. I mean, I'm not going to go through all the Q4 headlines and everything, but pretty big revenue beats, pretty big subscriber numbers. They're continuing to reduce costs. That said, he's going to kind of go into the lawsuit and things like that. But this is really just showing they're continuing to make progress. I've said it before, I'll say it again. They're probably going to trade pretty sideways until they get, basically in the final ends of being free cash flow positive. So who knows what the price is going to do in the meantime, but he's just kind of highlighting a lot of their progress that they've continued to make. I mean, breaking 400 million for the quarter is huge. So the fact that they're continuing to make that progress, reduce costs, is huge.
On the stock, but in my view, it's probably related to the antitrust complaint that we have filed last week.
All right, so what is the trajectory from here for Fubo TV?
Well, we've been taking market share for the last 7 or 8 years. Customers vote with their wallets. We have over 1.6 million customers at the end of the year, 2 million when you consider rest of world. So we're growing very nicely. We're developing our business, and we see continued growth.
He Oh yeah, these points here actually on the ad revenue. They're killing it on ad revenue. He talks about it. I'm not sure in this video or not, but he talks a bit more about the freemium model they're going to get to. A lot of the decisions they're making are going to continue to drive up this ad revenue. The big thing at that is they're really trying to diversify the revenue source, not have it just be subscription costs that they're collecting revenue on. Obviously, the more subscribers, they still have a cost associated. A lot of their programming they do pay per subscriber. So every subscriber they get, even though they're getting like $86 that 80 almost $87 customer per month. There's still a lot of costs associated with that. The ad revenue, unless they're really growing the team, there's no costs that come with that. So to have that revenue source, that's huge. That's the high margin stuff, and they're really trying to grow that. As we continue to see this grow with the freemium model coming out, and as they progress towards their goal, you should really see that number come up. Some of the messaging in the actual Q4 earnings call, they were talking about having double-digit increases again. So they were around the $38 million mark for Q4, and so it's like they're going to be well into the 40s, which is huge.
Over the next few years.
All right, and talk to me about, you had some strong words for what you see as some anti-competitive practices that are happening with Disney and some other players. Can you share with us your point of view on what's going on?
Sure. Well, these companies have a track record of anti-competitive behavior. We have been working very hard to try and rationalize the situation with them for many years, and this most recent announcement of a JV was the straw that broke the camel's back. They basically levied on us, rates that are 30 to 50% above market. They force us to buy unwanted content in order to access the must-have sports programming. They impose penetration rates that are above market and restrict us from providing features that we believe are valuable, relevant, and our competitors are offering. So that is a complaint that we filed, and we believe that we have overwhelming evidence to demonstrate their anti-competitive behavior.
He honestly, I don't think it's necessarily to break up the joint venture that they're submitting this lawsuit. That's, like you said, the straw that broke the camel's back on that. It's really the anti-competitive nature of it. The way Disney and Fox and Warner Brothers have really bundled things, so it makes the content that they want to distribute extremely expensive. Their Fubo is forced to pay tons of money for content people don't even watch, and they know, because they have the data, they know people aren't watching this other crap. So they're just trying to compete fairly. I'm sure so they're really, at the end of this, they're trying to just get the better terms to negotiate. And they had said it before, they would be free cash flow positive in 2023 if they had fair rates that they were paying for this content. So that's really what they're trying to get to. It seems like they have a good case for them to bring this up and lawyer up the way they did. It seems like they have probably pretty good evidence. If you want way more details on this case, you probably already follow him. But Down Badly, he's an actual attorney. He has a really good breakdown of this whole case and their chances of winning and things like that. So check that out if you haven't already. All right, let's keep going.
All right, and then I want to talk just about the whole streaming landscape in general. There has been talk of, kind of different entities partnering with different entities because it's just a fractured space, and then you have consumers starting to streamline which services they're going to pick up. Do you have any plans to, say, work with another streamer or come together in some kind of venture with another streamer?
No, that's sort of their plan. Our plan has been all along a consumer-friendly plan. Our goal is to remove the friction and fragmentation in the market, creating a more of a aggregated video experience that allows us to engage consumers along the demand curve. So essentially looking to offer a free, fast supported offering outside of the paywall, pay-per-view, TVOD, etc. over time. And so we believe that consumers really want to pay for one app, get all of their favorite content in a personalized and premium way in one place.
All right.
I think David hates this question by now. Their model really has nothing to do with partnering. Maybe they could, there might be some other creative ways to swing it, but really, the point is that Fubo is a separate entity and they buy all this content, and then a lot of it they're paying, they're paying per subscriber. So the point is that they have this whole bucket of different content that consumers may or may not want, and it's like you get your Fubo package, and then you have all these add-ons. I don't know if you've been on their website; they have tons of add-ons that they've been adding to their lineup. They streamline their plans, which I think makes sense, because I think that's just kind of confuses people. So they're just down to the pro and elite, but it's really this add-ons that's really building out here, which is the point of their whole business model. Really, is that you pay for your product, your base plan or whatever, and then depending on the type of content you like, you can pay and just add those. You don't have to pay and get all this, pay, $200 a month, and 75% of it is, content you don't even watch. That's what they're trying to. That's the point of this whole this lawsuit. So the point is that they can be a third-party aggregator and take all this, offer it, at different levels. I mean, a lot of these, it's like, some of them are pretty cheap, $2, $3, $5, $6, $10, depending on what it is. But it really gives you kind of a nice, a la carte version of, of TV to customers, where it's like they can go and just like, I only watch this stuff. That's all I want. The rest, I'm not going to pay for because I don't want it. I think it's funny this just keeps coming up though, but he's said it before that all this different content is sitting in different apps and different platforms, and if you want to watch this, you got to have the HBO Max, or you want this, you want Paramount. The point is that it'll all be in one place, and you don't have to have that fragmentation of going and opening up different apps to get content. It'll be in one place, and so that's what he's trying to create, is where they can just buy it and make it available to the customers who want it, and that's adds a ton of value. I think I've talked about this before. This adds a ton of value from the ad revenue perspective, because they're able to track, instead of that one user clicking on the Amazon app or clicking on the Paramount app, it kind of resets the clock of tracking those users and really giving them personalized data and ads. When it's all within one app, they can track the user through the whole process. They know what they're watching, what ads they're engaging with. They just have tons of data, and that's going to show in their ad revenue, and it already is, because their ad revenue is killing it. So that's the whole point, is that they are their own entity. They buy content and they give it to the people who want to watch it, and then that then adds the value to advertisers. Hopefully that makes sense.
We're showing some of your programming right now on our footage as well. I love seeing The Office. That was a favorite show of mine. Talk to us about your ad business and the expectations for the direction of your advertising market share.
Yeah, well, look, our advertising business has been solid, 14% improvement year over year to a record breaking 114 million of revenue. We have a very solid audience. It's a high quality audience, skewing male 18 to 49 that love to watch sports. And so for advertisers, it's a wonderful way to reach a highly coveted audience, in an environment that really creates a lot of brand recall.
And then
Yeah, I mean, they had their ad revenue. It keeps growing quarter over quarter. They, like you said, 114 million and continuing to grow. It's huge. And this, I mean, I'm a Fubo subscriber. As an investor, I do personally like the product too. It's not cheap. I pay like $115 a month with the Sports Plus and some other stuff on there. It's not cheap. It really is a premium product, but that's how they're marketing it. That's the audience they're targeting, and they're not just trying to be this cheap product. They're showing that if people are willing to spend over $100 a month for this, and what it has to offer, then those types of customers are worth more to advertisers. So they're really not trying to be this cheap product. They are catering to a certain audience, and that's, they're not trying to be as big as Hulu or Disney Plus or any of these others with 50, 60 million plus subscribers. To them, they're focused on a smaller, growing demographic that's more valuable from an advertising perspective.
How are you managing costs for your next quarter?
Well, as I said, the last 4 quarters, we've really delivered strong top and bottom line numbers, and we've been very, I would say, stringent in terms of cost management. We've continued to deliver against operating efficiencies, and if you look at the overall leverage of the business, it continues to come down across every expense category.
And what's the biggest thing consumers are tuning in for across your?
What was I gonna say on that? Sorry. Hang on, let me go back real quick.
And what's the biggest thing consumers are tuning?
Operating efficiencies, and if you look at the overall leverage of the business, it continues.
Oh, right, yeah. So Fubo's sitting at like 5 to 600, 550 employees, something like that. Like, they're pretty lean for, being a 1.3, 1.4 billion dollar company. So they're managing their costs pretty well. They had a tons of cash burn with the sports book and everything like that. So they're really in the optimization stage where they're kind of going. It doesn't sound like they're like letting people go and all this stuff. It sounds like they're really just streamlining their costs, working on driving towards that profitability target next year, and continue to make progress on that. So it's nice that it's probably been 5 or 6 quarters in a row now. They keep reiterating that free cash flow target. So the fact that they're still sticking to that is huge. I'm sure the stock price would reflect it if they did come off that. But the fact that it's been this long and they're still sticking to it and making progress on it is good to see.
Seems to come down across every.
And what's the biggest thing consumers are tuning in for across your platform?
Sports, and more sports.
All right, sports, and more sports. There it is. People love their sports. All right, David Gandler, he's the co-founder.
BKFC. Honestly, I've been into the bare knuckle fight championship. It seems like it's growing. I mean, the fact that Gandler's on the board there, making big investments. If you ever watch it, they have ads all over the place. I don't know the structure of it, but even just looking at like the BKFC Instagram posts, they basically say you can watch on the BKFC app or Fubo Sports, and Fubo Sports is like their free ad-supported channel. So if you have like Samsung TV, some of those other like free TV options, Fubo Sports will show up and they broadcast BKFC. So I've been really into that. It's actually super fun. Curious to see how they'll leverage that relationship in the future. But it's cool to see. Hope you got something out of this. I know I want to do a more of a deep dive on the ad revenue on the actual Q4 earnings call. They had a bunch of questions on it. For obvious reasons, they're seeing huge growth there. That's going to be a big part of them getting to their free cash flow target. So I'll probably work on putting together some content for that in the next week or two. Like I said, please subscribe to the page. Means a ton. Really appreciate it. Thanks for tuning in. See you.